Let me tell you about one of the most powerful and misunderstood wealth building tools in real estate. It's not appreciation, it's not cash flow, and it's not leverage. It's how the tax code rewards real estate operators. If you understand this, you stop playing defense with taxes and start using them as a weapon. Most people think taxes are something you react to at the end of the year. Real estate investors engineer their taxes up front. Here's why. When you buy real estate, the IRS lets you depreciate the property, even if the property is actually going up in value. That alone is powerful, but the real game changer is accelerated depreciation, commonly known as cost segregation. Let me break this down simply. Normally, residential real estate is depreciated over 27 and a half years, commercial over 39 years. That means a slow, straight line deduction. Cost segregation changes the rules. Instead of depreciating everything slowly, an engineering study breaks the property into components: flooring, electrical, plumbing, appliances, fixtures, and reclassifies large portions into 5, 7, or 15-year property. The result, you pull depreciation forward, massive paper losses, right now, year one. Here's the key part most people miss. Depreciation is a paper loss, not a cash loss. You can have positive cash flow, rising rents, increasing equity, and still show a tax loss on paper. That's the difference between being rich and being wealthy. Now let's go one level deeper. Under current tax law, if you or your spouse qualifies as a real estate professional, those paper losses can offset active income. That means W-2 income, business income, high earning cash flow, not just passive gains. This is how high-income operators legally pay little to no federal income tax while scaling massive portfolios. Let me give you a real-world example. Say you buy a $10 million property. Through cost segregation, you might accelerate $2.5 to $3 million of depreciation into year one. That can wipe out cash flow taxes, business income taxes, and in many cases, create carry-forward losses for years. You're not dodging taxes. You're following the incentive structure written into the tax code. The government wants housing built, improved, and operated, and they reward the people who do it. Now here's the part that separates amateurs from serious operators. This strategy only works if you're buying large enough assets, you're executing value add, and you're thinking in multi-year capital cycles. This is not for dabblers. This is for builders. But what about when you sell? Great question. Yes, depreciation is recaptured, but smart investors don't panic about that. Why? Because they refinance instead of selling, use 1031 exchanges, or redeploy capital into larger assets. They defer taxes again, and if they hold long enough, their heirs receive a step up in basis, wiping out decades of deferred taxes entirely. That's generational wealth. Let me be clear about something. This is not about avoiding taxes. This is about owning assets that the tax code favors. Employees earn money first, then pay taxes. Real estate operators buy assets, then calculate taxes. Completely different game. So here's the real question. Are you buying real estate for cash flow only, or are you buying it as a tax-advantaged wealth engine? Because once you understand this strategy, your acquisition criteria changes. Your hold strategy changes, your capital stack changes, and your definition of profit changes. If you're serious about building real wealth through real estate, this isn't optional knowledge. This is table stakes. The wealthy don't work harder to make more money. They structure smarter so they keep more of it. And real estate, when operated correctly, is one of the most powerful tools ever created for doing exactly that.